Good morning, everyone. This is Daily Trading Analysis with the weekly recap for this week, which it's packed with earnings, with economic data, with a lot of news, and we have a lot to cover. Overall, I think the market is not the economy, remember that. So we have a positive sentiment analysis of 55, a little bit higher than neutral, but this is due mostly because of earnings. Apple, Amazon, Microsoft, Meta, eBay, MasterCard, McDonald's, UPS, General Motors, PayPal, and the big Exxon and Chevron all reported earnings this week. And overall, it was good earnings. They were pretty good, beating expectations, but we have to talk about the underlying economy. So in here we have a mixed sentiment because the economy is doing pretty bad. We got a really sharp decline and concerning contracted and expected GDP Q1, which basically was minus 0.3%. So contraction, negative number. We were expecting minus 0.2, so it's not a big surprise, but still confirms what everyone was fearing, that the economy is contracting due to Trump tariffs. Then we got the PCE numbers, we got NFP, Nonfarm Payrolls, we got JOLTS, and everything is pointing towards the downside. Weakening, manufacturing contraction, missed expectation in the employment. The only good thing was the NFP that was a little bit higher than expected, but still a big contraction from the previous 200,000. So wage growth is being impacted in the JOLTS also. So we have two sides of the coin. We have bad fundamental data, GDP contraction, PCE going higher, non-farm payrolls being a little bit higher but lower than the previous one, consumer confidence being weakened, manufacturing contraction and weakness. So basically the fundamental side of things is pretty bad. But then on the other side, we have the big tech companies reporting good earnings. So what is going the market to do? The market is not the economy. Sometimes the market just wants to invest and have short-term gains. And I think this is what happens this week because we got so many of these consumer discretionary businesses reported earnings. Then we have tech, then we have more tech, MasterCard, McDonald's. This week was insane in terms of earnings. And they were so good that I think it was a counterweight of sentiment due to the bad fundamentals. We started the week pretty low and we left behind a little bit of a gap on the new week opening gap. But still, everyone was waiting for Meta and for Amazon to start reporting earnings, and then the momentum that we are going to be in the RSP is insane. So this is just short-term gains due to tech earnings. Remember that the underlying economy is not changing. The big issues, the big concerns are not disappearing. We got a contraction, an expected lower than expected contraction in the GDP, US GDP being negative. That's insane. From a previous 2.4, insane impact. Then we have PCE, remembering us that the prices are still going up. Then we have non-farm payrolls, employment, JOLTS, consumer confidence, all being weakened. So we have to really pay attention not only to the short term, but also to the mid and long term. And once the earnings finish, are all complete, we have to be really careful. So this is my open your eyes. And let's focus on the price action in the short term, but don't forget about what is under that circumstance of earnings right now. Let's move into the charts because, as always, we are going to review from top to bottom. This is the Nasdaq weekly chart, another 3%. We are in two pretty good weeks, again due to earnings, but we are in a very specific circumstance. Let me just show you something. From the highs to the lows of this, we have the golden pocket. This is a fib retracement. We are right here in the golden pocket, in between the 61.8 and 65% retracement from the lows. So this is the first thing that I would like to highlight. In terms of price action, we got a good run. Don't get me wrong. This was a big bounce of the 200 moving average from the weekly chart. But I think it's time, now that the earnings are done, I think it's time to really take a step back and focus on what is happening and how did we get to this point. Because this place, it's pretty challenging. I think we might see a little bit more push, but I'm expecting a pullback. The same way that after this big push on the tariffs pause, we got the pullback and then we went straight up due to earnings. I think right now it's time for a pullback. So don't get too excited. Don't buy the top. Don't buy the top. Wait for better opportunities and better positioning. And the same way that the 1 hour chart was so bullish and then we swiped the lows and we were just straight up, this is a good run, but it's unsustainable because at some point there will be no more buyers and big players are going to take his time to adjust for better long-term positions. So I'm waiting for a pullback in terms of technical price action. We marked this buy set liquidity the same way we marked this one. We are in a higher new week opening gap from the late March. So this can be done. This liquidity also can be done. Then we got last week low. We pushed through last week high. Oh, this is the other way around, man. This is last week high. Sorry about that. So we pushed the last week high. We are extending the weekly, but this is just too much. I think we need a little bit of pullback. The 200 moving average is trying to catch up. We have some kind of liquidity down here that I would like to see. It wouldn't matter if we just pull back a little bit. So that's what I'm expecting. That's what I will be preparing for. And there was a gap in here for the new week opening gap, and we have the 1 hour. So basically, oh, by the way, this inverse on the daily got destroyed. This inverse was really, really holding the price back. So this can be done also. Let's clear a little bit all these. This 1 hour needs to hold. Let me check, okay. So let's go back to the 1 hour. As I was saying, we need to pull back a little bit. I wouldn't even buy this low. Why? Because this is just not enough pullback. This is just a consolidation. We need more pullback in here. Because if we open our eyes, if we check the 1 hour chart, this is just a big V reversal on the 1 hour. And at some point, we need to wait for a little bit more of pullback for higher time frames. The 4 hour, it's a V reversal, but we need some kind of pullback. And this is a good spot in both the daily and the weekly to just rest a bit. There's like 1.50% until the next buy side liquidity. We might get these guys and then just basically pull back. So be careful buying this top. Be careful losing to FOMO and straight up continue blindly buying this market. Because this is just momentum. As I was saying, RSP, look at this. Look at the RSP down here. Look at the momentum that is basically pushing all the stocks. We are at 85% of stocks above the 20-day moving average. But long term, above the 200, it's only 34. And this is key to understand. There's a difference in between long-term sustainability and short-term momentum. And this is what we are seeing right now. The percentage of stocks about the 50-day moving average is just 50. Half of them are, this is balance. In terms of trend, we don't have trend. We don't have long-term. There's 34%. Obviously, this was a nice buy signal below 20% of stocks below the 200-day moving average. That was a buy signal for the biggest investors, for the big participants, for funds, for banks. That's why I told you this low is going to be bought up, but not because of us retail traders, because of big money is going to jump in no matter what to sustain these positions. But what we are seeing here is big momentum playing up. So don't lose this focus. The interests are still pushing higher. We have 4.3 until summer, and then maybe an interest cut in CQM, which is, let me just, June. And then we have N. We have N in July. Basically in July, we are at 4.1. So maybe one interest rate cut this summer. But everything is pretty volatile. Tariff decisions are going to be played out in the long term. So we have to really wait for that. There's a lot of information. I want to be bullish, but right now, the move already happened. Don't lose to this. We are way more smarter than other people. We try to think twice and elaborate our thinking process based on all information that we have. And right now, this is what I'm seeing. Be careful with this top because I'm expecting a pullback. Other things, well, tech was pretty much going up 1.67% in terms of sector funds. In terms of energy also, but look at this downside. Chevron and Exxon were reporting bad earnings. Financials, 2%. This is people betting that the financial system is going to be supported. This is fueling the S&Ps. The banks were doing pretty good. Pretty good. Look at all these. It's 2 to 3% in all the banks. Semiconductors sector was also reversing. So we are in an environment in which we are reversing this big issue, big downfall that we got. Everyone was panicking, and even the small caps are trying to see some kind of momentum. But let me tell you, this was expected because in the short term, people is going to play the earnings. But we have to think twice about this. There's a lot of volume coming in both the ES and tech. Tech was really, on Tuesday, was brutal in terms of volume. Was insane volume. So tech was leading this week. But the ES was also leading on Friday because of financials and because of start of the month inflows. So what we are seeing here is just a big bet on buying the dip, by big investors, short-term opportunities for retail traders. But don't get me wrong, this is a bad spot to continue moving higher. The 1 hour is so extended that we need a pullback, and we have to be smart about our positioning. And right now, I'm waiting for 19,000. We are at 20,100, and I'm expecting this kind of pullback or even a little bit lower to catch up on some lows 19,000. And that's all from my side. As always, thank you for your time. If you found this video useful, please give it a like, subscribe to the channel. I do this kind of weekly recaps every Saturday in which we talk about everything you can imagine. So if you are new, welcome. If you are coming back, thank you for the support. Thank you for the views, because I'm doing this mostly for you. I do this also for myself, but I try to teach everyone how I see the markets, because this is how I understand big people, big experienced players are doing this business. And if you don't do this, you are lagging behind. But remember, the most important things are patience, discipline, and risk management. So stay safe, everyone. Have a nice weekend, and see you next week on Monday.